Hey everyone, welcome back to Corporate Decoder. Today, Starwood Property Trust Inc. STWD just filed an 8K announcing a new debt offering, and I am seeing one potential red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing mostly details the terms of a new debt issuance, but there is a clause about future guarantees that could change things down the line. Alright, let's dive into what Starwood Property Trust Inc. STWD announced on the 10th of July 2026. It is a current report essentially informing everyone about a significant business event. The key date here is the 10th of July 2026, which is when the major event we'll discuss actually happened. We are talking about Starwood Property Trust, Incorporated, a real estate investment trust, or REIT, that focuses on mortgage-related assets. They have a market cap of about $6.3 billion and their stock is trading around $16.46. They've got over 300 employees. Big players like BlackRock and Vanguard hold significant stakes, which is pretty standard for a company this size. They are incorporated in Maryland. Their commission file number is 001-34436, and their IRS Employer Identification number is 27-200-47747. On the New York Stock Exchange, their common stock trades under the ticker symbol STWD. The main event here is under item 1.01, which is about entering into a material definitive agreement. In simpler terms, they signed a big, important contract. What they've done is close on a private offering of $500 million worth of unsecured senior notes that are due in 2029. These are basically loans the company is taking out that they promise to pay back with interest. This offering was priced back on the 25th of June, and the deal officially closed on the 10th of July. Now, what is interesting is how they plan to use this money. A big chunk of it is earmarked for financing or refinancing green and social projects. This means projects related to environmental sustainability or social benefit. It is a trend we are seeing more and more in corporate finance. They might even use some of this money to pay back other debts, like their 4.375% senior notes due 2027, or for general business needs. These new notes are senior unsecured notes. That means they aren't backed by any specific assets. If the company were to go bankrupt, the people who hold these notes would be paid back at the same level as other unsecured creditors, but after any secured creditors who have claims on specific company assets. These notes will mature on the 15th of August 2029. They carry an interest rate of 5.875% per year, and interest will be paid twice a year, on the 15th of February and the 15th of August, starting in February of 2027. Here is where it gets a bit more complex and where I see that potential red flag. When these notes are first issued, no subsidiaries are guaranteeing them. However, the agreement, called an indenture, has a clause called the Springing Guarantee Covenant. This means that under certain circumstances, one or more of their domestic subsidiaries might be required to step in and guarantee these notes. It's like a backup promise, but it only kicks in if specific conditions are met. The exceptions for excluded subsidiaries or securitization entities are important here, meaning not all subsidiaries are on the hook. Let's talk about how these notes rank in terms of payment. They are senior unsecured obligations, meaning they rank equally with other senior unsecured debts. They are what is called pari passu in right of payment with existing and future senior unsecured debt. Think of it as being on the same level playing field. However, they are considered effectively subordinated to any secured debt. This means if the company has loans backed by specific assets, those lenders get paid first from those assets before unsecured lenders. The notes are senior to any future subordinated debt, and importantly, they are effectively subordinated to the debt and other liabilities of the company's subsidiaries, except for those subsidiaries that might become guarantors. Now, if a subsidiary does become a guarantor, their guarantee will be a senior unsecured obligation of that subsidiary. It will rank equally with that subsidiary's other senior unsecured debt, but still be effectively subordinated to any secured debt of that subsidiary. This is a crucial part. The guarantee from a subsidiary will automatically terminate and the subsidiary will be released from its obligations if certain conditions are met. The main condition is that the notes achieve an investment-grade credit rating from 2 or 3 selected rating agencies, and there are no ongoing defaults with the company. An investment-grade rating is generally considered a lower risk level by credit agencies. Starwood Property Trust can choose to redeem some or all of these notes early. Before May 15th, 2029, they can redeem them at 100% of the principal amount plus a make-whole premium. This make-whole provision is essentially compensation to the note holders for paying off the debt sooner than agreed. After May 15th, 2029, They can redeem them at their face value plus any accrued interest. They also have an option to redeem up to 40% of these notes before May 15th, 2029 using money from new stock offerings. If they do this, the redemption price will be 105.875% of the principal amount, meaning they'd pay back more than face value. This usually happens if interest rates fall significantly and they want to refinance at a lower cost. If there is a change of control triggering event, which means something significant happens that changes the ownership or control of the company, they will have to offer to buy back all the outstanding notes. This is a protection for note holders in case of a takeover. They would have to pay 101% of the principal amount plus accrued interest. The indenture also includes covenants, which are promises the company makes. These covenants generally limit the company's ability to take on more debt, require them to maintain certain levels of unencumbered assets, and set rules for merging with other companies. One key covenant is that they must maintain total unencumbered assets that are at least 120% of their outstanding unsecured debt. This is a cushion to ensure they have enough liquid assets to cover their unsecured obligations. Similar to the subsidiary guarantees, some of these covenants will also automatically terminate once the covenant termination date is reached, which is tied to those investment-grade credit ratings we talked about. Finally, the indenture lays out events of default. If any of these happen, like failing to pay back the notes or breaking other major promises, the entire principal and interest on the notes could become due and payable immediately. Item 2.03 is pretty straightforward here. It is just confirming that this new debt issuance creates a direct financial obligation for Starwood Property Trust, Inc. The information from Item 1.01 is incorporated here by reference. Item 9.01 lists the exhibits filed with the report. The most important exhibit is 4.1. This is the actual indenture, the governing document for these senior notes, dated the 10th of July 2026. It also includes the specific form of the 5.875% senior notes due 2029. So what is the story here? Starwood Property Trust, Inc. STWD has successfully raised $500 million by issuing new debt. They're using a portion of this for green initiatives, which is a positive signal about their strategic direction. The terms seem fairly standard for an unsecured senior note offering, with options for early redemption and protections for bondholders in case of a change of control. The springing guarantee covenant is the detail to watch closely. While the notes start out unsecured by subsidiaries, the potential for them to be guaranteed later adds a layer of complexity. If their credit rating improves to investment grade, these guarantees and some restrictive covenants can disappear. This could mean less financial flexibility for the company in the future if they can't maintain those higher credit ratings. However, it also means that if they are doing well enough to earn investment grade, those stricter rules will be lifted. For the investors, this debt issuance doesn't immediately change the risk profile in a dramatic way, as it is unsecured debt. However, the market will be watching to see if they deliver on their green project financing and if they can maintain or improve their credit standing to meet the conditions for those covenants and guarantees to be released. It is a careful dance between raising capital and managing future obligations. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.